Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Extra, extra, read all about it. The annuity king himself, Tony Walker, explains why annuity sales are through the roof as savers flock to annuities for protection and guarantees. Extra, extra, read all about it.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, nationally recognized retirement specialist and six-time author and fiduciary, Tony Walker.
Ever since the first ships loaded with precious cargo crossed the Atlantic, the insurance industry has protected consumers and businesses from loss. Whether it's protection for the loss of our cars, homes, health, and the loss of life, insurance companies are in a most unique position many other financial institutions are not, particularly those of Wall Street, which seem to be more interested in growth versus interested in protecting people's money. Yet it's not just our valuable stuff and our very lives insurance companies protect, but something else that most people don't think of. They're in the business of protecting our income and making sure we don't run out of money in retirement. The given name of such an insurance product that can provide savers an income they can never outlive, it's called an annuity. A name that is not only misunderstood by Wall Street and many financial pundits, but also that if it came to any other name, can anyone say, mailbox money? Yes, folks. If we could only change the name of annuities to mailbox money, then people would probably flock to them, as we are seeing more and more people come to annuities. But therein lies the problem with them. It's not that they can provide savers the way to guaranteed income, which they can, but the annuity, when mentioned to most people, conjures up in the minds of savers the much misfortune that is being maligned about them. Things that basically are either untrue or are misunderstood by a financial world that is turned off, for whatever reason, by annuities. Which is why today we're going to talk about what is really going on in the real world of savers in retirement and why more and more savers are flocking to these products called annuities. Well, welcome, folks, to the Worry-Free Retirement. And yes, I am that little man in the sweater vest, the annuity king himself, Tony Walker. And along with us in the studio on this December 19th, 2023, as we record our show in our studios in Louisville, Kentucky, is America's favorite financial sidekick, Mr. Aaron Orander. Good morning again, Aaron. This is our second radio show we're recording. It's been a long morning, but thanks for hanging in there with me.
Hey, no problem. Good morning to you, sir, and good morning, audience. Tony, I know you're not going to believe this. I got another person I got to give a shout out to. I saw a lot of people this weekend, okay? I want to give a shout out to Greg. So, Greg and I actually go to church together, and we were sitting next to each other during our end of the year business meeting, and Greg's on our finance committee. I'm on our nomination committee. We both had reports to give, and we were just kind of sitting there waiting for our turn and started talking about the radio show. And he just said, you know, I enjoy it and everything else. So thank you for listening, Greg, and good morning to you.
Well, I appreciate that. Thank you, Greg, for listening. Okay, Aaron, have you ever conjured up in your mind a name of something or attribute of something? And if you could just change the name, maybe it would just change your perception of it. Does anything come to mind that just has a bad name and it's like, man, if we could just change the name of it?
Oh, I don't know. I do know a lot of people don't like the word moist. I've seen that around. Like a lot of people, like they did a study and like one of the least favorite words apparently from the dictionary or something like that or people's vocabulary is the word moist. So they took that. You've heard of a moist towelette, right?
Yeah,
well,
right.
I think that company, whatever that company is, I think they've taken the word moist out of moist towelette. So now it's just a towelette.
The Mississippi's a great river. You ever been to Moisty Grove?
No, but I've been to the Rocky Moisten Range in the United States of Amoistica.
That is really interesting. Yeah, well, what's happened over the years, and I don't know when this started, quite frankly, but I think because annuities are issued by insurance companies, and most of the financial world really is not run by insurance companies, much to the, in fact, I'm going to quote some statistics here. Let me kind of give you an idea. And basically, more and more people are purchasing annuities. But in the scheme of things, folks, this is a huge, huge financial world with trillions and trillions and trillions of dollars. And the amount of annuities out there, well, let me read this. This came from LIMRA, okay, the Life Insurance Marketing and Research Organization that kind of tracks annuities. So basically, now this came out in July of 2023. Total annuity sales increased 12% over the year in the second quarter, which was $88 billion, driven by a record high number, blah, blah, blah. Then it goes down 2023. Total annuity sales jumped 28% to $182 billion in the first half. Those are billions is a lot of money, Aaron, but that billions don't really compare to trillions. You see what I'm saying?
88 billion, I'd be good with like 10 billion. If you just want to, 10 billion, I'd be happy.
So yeah, basically, let me see if I can find another article. I had another article in there somewhere. I think I misplaced it. But basically, folks, the jury's out. Annuities are becoming more and more popular, contrary to what Wall Street and a lot of the soothsayers out there are saying, and to stay away from it. And I think the reason, bottom line, the reason that a lot of people are starting to turn to annuities is because the industry, I can remember years ago, Aaron, in fact, people kind of got on me for saying these two words. I would say annuities provide guaranteed income for life. And they would say, well, wait a minute, how can you say guaranteed income? You can't say that. And I'd say, well, yeah, it's in the contract. And now if you look at a lot of advertising, I'm talking about from the big boys, folks, if you watch ads really closely on TV, radio, on the internet, you're seeing more and more of these big financial institutions, whenever they say the word guaranteed income, that sounds pretty good, doesn't it? If I say guaranteed income for life, that sounds good.
Right.
Now, if all of a sudden I say annuity, you think bad, right? But that is what an annuity is. So if I change the term of the annuity and call it, hey, Aaron, what if I could get you guaranteed income for life, something I call mailbox money? Mailbox money sounds pretty fun, doesn't it?
Yeah.
Yeah. And I don't call it an annuity, but that doesn't change its stripes. It's still an annuity. So we have to understand, why have these annuities been maligned? Why are more and more savers now coming over to this side that we've preached for years? And that's making sure, not everything, but making sure, if you're a saver, that you have some of your money in these guaranteed products called annuities. So when I come back, we're going to try to understand why they're developing more and more annuities, why they're getting more and more complicated, more varieties out there, and how we at Tony Walker Financial have been using these products long before most advisors could even spell annuity, and how our beloved mailbox money is going to help you better understand these products and help you feel better about purchasing an annuity from Tony Walker Financial. You're listening to The Worry-Free Retirement. We'll be right back. Are you retired or retiring soon? Do you have a 401k, IRA, 403b, TSP, or lump sum pension that you'd like to move to safer territory? Did you know that all the money you see on your 401k statement isn't really yours? Depending on your overall taxable income, the government essentially has a lien on your 401k that can tax as much as 40% of your money when you go to take it out. And with current tax rates set to expire in 2025, and considering the fact that our nation's debt is spiraling out of control, do you really think taxes will go down after 2025 or go up? Here's my advice. Don't sit around waiting to see what Uncle Sam will do to your taxes in 2025. If you have more than $250,000 in retirement assets, contact us now by logging on to TonyWalkerFinancial.com or give us a call at 877-499-9255. According to LIMRA, which is the organization that tracks the sale of insurance products, including annuities, the sale of annuities in 2022 reached over $310 billion. That's a 22% increase over annuity sales in 2021. And listen, 17% higher than the record sale of annuities back in 2008. So Aaron, you remember 2008. I talk about it all the time. Why do you think in 2008, that's when the stock market crashed. Why in the world did everybody flock to annuities? Because we sold them like great guns back then. What was going on?
I think people were scared to death. The stock market crashed, and everybody's money that they thought was secure went bye-bye.
And it's gone.
Bye-bye.
In fact, and I think Derek's got this queued up, and it's not funny, but 60 Minutes did a wonderful story back when all that happened, and they interviewed people who were basically near retirement, planning on using all that 401k, and listen to the pain and anguish of this young lady who just found out how much money she just lost in the stock market and her 401k plan.
Until she lost her job, Kathleen Coleman had spent nearly 30 years working as an executive assistant on Wall Street. She doesn't have much to show for it.
Tell me about your 401k.
Does this answer the question?
This is what it was in 2005. 2007, you're down below 2005.
Right. Another one went down almost $40,000. One was
Right.
88,000, and then it went down to like 50.
So what has led to the explosion in the sale of annuities as we record this show in December of 2023? Well, the use of the word guaranteed, or shall I say words, guaranteed income for life. That's why. Guaranteed income for life. So if I just say that, folks, that there is a product out there that you can place for retirement, either in your IRA or outside your IRA, and that product would provide guaranteed income for the rest of your life, no matter how long you would live, I'm sure you would say, wow, that sounds impressive. Tell me more about this product. The problem is, as soon as annuity comes out of my mouth, you've been told all these years how bad annuities were. You've been told by Wall Street to avoid them because they don't sell annuities, quite frankly. They got a conflict of interest here. And then all of a sudden, you're saying, well, wait a minute, Tony, I've always heard bad things about annuities. Incidentally, for years I've sold these products, spoken all over the country to agent groups because of our expertise in using annuities within the retirement planning process. I can say this, they are the only product you can buy that guarantees an income for life. So here's the thing. If we go back to 2008, let's think about this a minute. Could we have another 2008? Well, possibly. I mean, that was pretty dreadful, but possibly. And I think what happened was, what 60 Minutes uncovered was, that was one of the first major downturns where people, Aaron, were actually pretty close to retirement. 1987 was a collapse in the market. A lot of people were still young and working. 2000, 2002, a lot of people were in their 40s and early 50s when that debacle happened. But you go to 2008, and a lot of people then were approaching retirement, and all of a sudden to see a 401k magically become a 201k, that would be scary to say the least. So what could happen? So if you're retired or nearing retirement, we have to always assume the worst when we're doing retirement planning. So what could happen if we don't have any annuities? If you're buying stocks, bonds, mutual funds, which we can get those for you through Charles Schwab, we do that as well. But we don't like putting all of a saver's money in that particular portfolio, especially if they're at or near retirement, because if that thing drops, if it goes down 20, 30, 40%, you've only got one or two options. You're going to have to put off retirement, or possibly, depending on how much you lose, you're going to have to go back to work, which I don't think is what we would call a worry-free retirement. So when I come back, what we're going to do is we're going to examine the different types of annuities we're using for mailbox money. We're going to imagine we've changed the name of annuities to mailbox money. Help us understand what that mailbox money's purpose is. And if you do decide to keep some money with us through our Charles Schwab platform, how do we make sure that we keep money accessible, use and enjoy the money, but also without the fear of one day running out? I'm Tony Walker. When we come back, we're going to dive into why so many savers are flocking to annuities, and you should consider doing as well.
Our employee spotlight shines brightly today on Beth Wisman, and as we record the show, you're brand new to Tony Walker Financial. So what I'd like you to do, without naming company names, but tell the folks a little bit about your background in this industry.
Okay, so prior to coming to Tony Walker, I managed the annuity operations and new accounts department at another brokerage firm. And so I come here with that knowledge.
And we're so excited to have you because of the explosive growth in the annuity department, but also the onboarding process where people come on So we just got through with our staff retreat here. Kind of explain to people what your new role will be here at Tony Walker Financial.
So my role will be to onboard new clients, and I will be reaching out to them to gather all the additional information that we need to make sure we have all the data in the system, as well as statements to make sure we have what we need to issue paperwork.
And we look so forward to having you on board, and thank you for joining Tony Walker Financial. Hopefully we have many years to come where we're working together. So thank you, Beth.
Great. Thank you.
You're welcome. Welcome back to the Worry-Free Retirement. And as we kind of round out the year 2023, I still can't help but hearkening back to year 2022, which was a tough year for us in our Schwab platform. Just to summarize 2022, in case you've already forgotten, the Fed raised interest rates so quickly that it did a number on the bond market. And although the bond market usually does the opposite of what the stock market does, both stocks and bonds in 2022 went down on average 20%. That's a lot of money, folks. If you had $500,000 in a 401k or IRA and you did what's called this 60-40 rule of thumb, that's what Wall Street has always used to try to mitigate risk. In other words, they might have 60% in the stock market, 40% in the bond market. The idea is if one's up, the other's down. So if we're in some tumultuous times, you're not going to lose a lot of money. Well, 2022, that 60-40 theory, if you will, fell apart. And for the first time, many people came to us dismayed over what in the world just happened when they thought they were so-called diversified. So diversified, folks, if you're a saver, doesn't mean that you're going to have less risk. Diversified sometimes just means that you've got things spread all over God's creation, but you could still have, as 2022 proved, a lot of risk. So Wall Street, although they're starting to look at annuities, some of the bigger firms are starting to offer them. The reason Wall Street does not like annuities is because in most cases, you cannot charge fees on them. Now that's about to change. You're seeing more and more favorable article about annuities from Wall Street, but those Wall Street folks are now able to charge fees on annuities, something they've never been able to do. And while we've at Tony Walker Financial, actually, we get paid commissions on annuities. We have looked into fees on annuities. We can charge fees. But what I've found is the problem with charging fees on annuities, if the annuity goes down in value, okay, and we're charging a fee, well, we're right back to, we might as well put you in Schwab. I mean, why would you want to put money in an annuity with a fee when you can buy an annuity without a fee? And then we can come over to Charles Schwab and have complete access to our money. And we charge 0.8%, some of the lowest fees in the industry. So we would have the Schwab for accessibility to your money. So let's talk about what we call our split IRA concept and how this plays out and why we have sold so many annuities to savers over the years and why I think many people are starting to do what we've been doing for years, and that's offering a combination of products like bank products, mutual funds, ETFs, stocks, some bonds. And now a lot of advisors are starting to bring in what we call fixed annuities. So there's basically just a couple of different types of fixed annuities out there. There's what's called a fixed interest annuity, which as of the date of this recording, those rates are coming down, by the way, folks. The average 5-year fixed interest annuity that we offer on a guaranteed basis is around 5.5%. So the way a fixed interest annuity would work, let's say you have $200,000 in an IRA or $200,000 languishing in the bank, it doesn't matter. You could write that check to the insurance company. The insurance company, by way of contract, is going to guarantee your principal is protected for that 5-year period and guarantee, in this example, they're going to pay you 5.5% on that money. So every year, you're going to get 5.5% credited to that account. At the end of 5 years, you could walk away from that annuity and take the entire principal plus all the compounded interest and walk away. So that breaks one of the myths that a lot of people say, well, these annuities are tied up forever. It just depends on the type of annuity. If you get a 5-year annuity, after 5 years, it's completely available. And keep in mind, too, because we have to deal with a lot of death claims at Tony Walker Financial based on the number of people we serve and their age, in most cases, if you died during what's called the term, let's say you die in the 3rd year, the insurance company will pay that money out to your beneficiaries, and they usually will actually do away with any penalties. So the only problem with annuities is during the term, you've got to understand they have huge penalties if you get out of those annuities within that term, which is why, again,
we hardly ever suggest people putting more than 70% of your overall assets into annuities just because they are fairly illiquid. In other words, very hard to get it out without penalty. So that's one type of annuity. It's called a fixed interest annuity. Then there's also something called a fixed indexed annuity. A fixed indexed annuity, these became popular in the late 90s. We started offering these around 2001, 2002 when the market crashed. They're a unique tool. Now, you got to remember, with a fixed indexed annuity, you're not going to get rich on these things, folks. I know you could make some high returns. We've had some years where fixed indexed annuities have done great. But in many cases, a fixed indexed annuity is not going to make a lot of money. You know, if it on average, if it made 4 to 6%, long term, I'd be happy with a fixed indexed annuity. The beauty of a fixed indexed annuity is, again, like the fixed interest annuity, your principal's protected. And whatever it might make that year, whether it's 2%, 8%, 12%, whatever it makes, that money is locked in forever on that portion. And then next year they start this process all over again. So with a fixed indexed annuity, whatever gains it makes, it can never lose in the future, no matter what the stock market might do. So that's fixed indexed annuity. That's the second type of annuity that's very, very popular. A third type of annuity is kind of replacing the old variable annuities. We don't see many of the variable annuities anymore, mainly because they're got a lot of risk and a lot of fees associated with them. They just really don't make a lot of sense, quite frankly, because of that. But the industry is coming out with an interesting product that we have used on occasion. It has some merit. It's called a buffer annuity. And it kind of meshes a fixed indexed annuity with a variable annuity in that you can limit the upside of the growth and limit the downside. So let's say you have a buffer annuity and you say, okay, I want to get gains up to 20%, and if the market goes up 30, they're going to lock it in at 20. That's your upside potential. And then along with that buffer annuity, you elect to take a downside risk of 15%. In other words, if the market crashes, the most you can lose is 15% of whatever you had in there. So a buffer annuity might be good for somebody who really is a little more on the younger side. They're not going to need this annuity for several years. They want to try to let it grow, but they don't want to take so much risk, and they kind of just want to let the market do its thing. And then after a 10 or 15 year period, they're going to use that and either annuitize it for mailbox money, or they could take it out and just do whatever they wanted to. So for savers, those are the three main type annuities we offer and we look to for assistance within our income planning department. So what we're going to do when we come back, I'm going to take an actual case study and we're going to dive into the split IRA and how we actually use two different types of annuities for this particular person, and then brought in the income rider, that's the mailbox money portion, and how that person went from risk and uncertainty with a money manager paying 1.5% a year, and also the three most dreadful words you can hear when the stock market is going down. I'm Tony Walker along with Aaron Orender. We will be right back.
Have you recently retired, been laid off, or offered a pension buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no obligation appointment. Let us help you today.
With the uncertainty of the stock market, now may be the best time to consider moving your 401k to safer territory. To talk to me at no cost or obligation, simply log on to TonyWalkerFinancial.com.
Welcome back, everybody, to the Worry-Free Retirement. I am America's favorite financial sidekick, Mr. Aaron Orender. Got the TNT here for you. Tony, I've been hearing a lot about trusts. I'm thinking about putting some money in a trust, but I really don't understand them. They seem kind of complicated. In your opinion, what are the main things I need in place at my death?
Okay, thank you. And that comes up a lot. And by the way, folks, I'm not an attorney. I've been doing this a long time, worked on a lot of estate planning cases, but again, I'm not an attorney. But for savers who want to keep things simple, this is just my suggestion. Okay, here's what I would always have available and make sure you have in place, okay? Can't always say I would agree that you need a trust. A lot of times I think trusts are unnecessary, but basically you could have a simple will. A simple will just tells where everything's going to go when you die. Now, for my purposes, I do have a trust in my will, which is called a testamentary trust. And when I die, what's happening is I'm going to have money set aside into that trust, and that money is only going to be used and designated for grandchildren's education costs. So that would be an example of a testamentary trust. It's already written, but it won't be funded until I die, okay? The other thing that you might want to do is make sure that you have a durable power of attorney. Now, you might have a power of attorney, but the word durable covers disability and everything else. So we're finding this out. If a client calls in, let's say a spouse of a client, and needs information on the other spouse's account or whatever, without that durable power of attorney, even if they're in good health, we cannot share that information with the other spouse if the money's not in their name. So that durable power of attorney can also be assigned to a child, an adult child, to act on your behalf if you're disabled. We're seeing this more and more as people get older, just old age catching up with them. They can't keep up with things. A lot of times an adult child will be the durable power of attorney. By the way, be careful too of giving that durable power of attorney to only one child. I'm not saying they can get a little reckless, but boy, you're giving a lot of authority to one child, and I have seen families have a lot of issues that crop up by having one child that ends up taking control, and maybe too much control, if you know what I mean. And finally, I would say make sure you update all of your beneficiaries. Make sure that your life insurance, annuities, IRAs, those go by beneficiary, 401ks, make sure those are current. I remember years ago studying under Mr. Ed Slott, a well-known CPA, and he tells the story of a gentleman that had $1 million pension. He had his wife as the beneficiary. He divorces, he remarries, he passes away, and Aaron, guess what he forgot to do with that $1 million?
He forgot to change over his beneficiary.
That's right.
So Miss Ex-Wife came calling.
Absolutely. And Miss Ex-Wife won that deal because beneficiaries always trump anything else. So they'll trump the will. Even though he changed the will, apparently that wasn't good enough. All right, in our remaining time, here's the case I wanted to share with you. Interesting case, all right, changing the names a little bit to protect the innocent. A 65-year-old comes in, he and his wife, they're retired. The money manager says these 3 words. They're the 3 words nobody wants to hear. This was last year when the market was crashing. Do you know what those 3 words are, Aaron?
Got no money? I don't know.
And it's gone.
Hang in there.
Hang in there, yeah.
Hang in there. Or be patient. He said, finally he just shook his head. He said, I'm tired of hanging in there. I'm tired of being patient. I'm 65. I just want to enjoy money. So what we did in their case, and we can do this for you, we moved their 401k, actually it was an IRA at this time with the money manager, to our split IRA concept. We put some of that money with Charles Schwab. He wanted to take a little bit of risk. We put that in our growth strategy, which does have about 75% equity exposure. Again, we charge 0.8% for the Schwab bucket. And then he had a large enough account where we divided up into 2 different annuities. We chose a 5-year, multi-year guaranteed annuity. Currently, as of the date of this recording in December of 2023, they're paying about 5.5% guaranteed. So he's got that money out there that's guaranteed, that's not subject to stock market or interest rate risk. And then on the back end of that, we put in our beloved
mailbox money.
And that's where we'll use a fixed indexed annuity with what's called an income rider. So when they get into retirement down the road, they can kick that income in and provide that guaranteed income they can never outlive. So the key is how much goes where and when do you draw the money out and what are the taxes? Well, folks, that's what we do for our individual clients. When you meet with me at Tony Walker Financial, we're going to design a personalized game plan that fits your situation and utilizes these different products and expertise that we have to offer our saver clients. So if that's you, if you want a free second opinion and you just want to sit down and talk, it all starts with a free phone call. You do that by logging on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com. Just click on that little red box and we'll get that free phone call started. And if it warrants, we'll be happy to meet with you in person at either our Bowling Green, Louisville, or Lexington, Kentucky offices. That's TonyWalkerFinancial.com or give us a call, 877-499-9255. That's 877-499-WALK. Well, we hope you've enjoyed today's program. We'll look forward to talking to you next week on the Worry-Free Retirement. But between now and then, if all else fails, you be worry-free and make it a good one.